Hello and welcome to this video on the Boston Matrix. So in this video we're going to look at what is meant by the product portfolio. Then we're going to look at the Boston Matrix diagram. And we're going to look at the characteristics of the different categories that we find in a Boston Matrix diagram. And then lastly, assess the usefulness of the Boston Matrix, which is a way of assessing our product or evaluating our product portfolio. So let's start off with what a product portfolio is. Product portfolio, quite simply, is the range of products or brands that a firm has under its control. And what we really want to do, make sure from a business, is that we have products in our portfolio at different stages of the product life cycle. So if you have a look at stage 3 here, this point in time, stage 3, this is quite a good situation for this business, because whilst product A has declined and has finished, product B, which we brought out slightly after product A, has just finished the cash cow stage, finished the maturity stage. So it's generated a lot of finance for us. Likewise, product C, which we brought out just after product B, is now reaching the maturity phase. So it's just about to generate a lot of cash for us. And finally, product D, which we brought out after product C, has just finished the end of the introduction period, and it's looking as though it might start to go into growth. So here we have one product that's coming to the end of its life, one product that's generated a lot of us money, one product that is about to generate us some money, and one product that could generate us some money. So we have a nice balance, nice range of our products here. So businesses will want to analyze their portfolio of products and make sure, right, do we have products in different positions within their life? And if so, should we be encouraging some, or how should we, what decisions should we be making about them? And the Boston Matrix is a way that a business might do it. It's called a matrix because it's quite a simple grid here. We've got 4 squares, a sort of 2 up, 2 down approach. And the Boston Matrix is a model that we use to analyze a firm's product portfolio. And we do it by considering the 2 characteristics for each product that a business might have. Firstly, the market share of the product, and secondly, the rate of growth within that product's market. And we have 2 categories. We have high and low. So here we have high and low growth rates, and here we have high and low market share. And so what we'll do as a business is we'll think about all of our products, our range of products, and decide, right, where do we think they would fit on this grid? And we give each of those categories, each of these 4 boxes, a name. So businesses that have a high market share, so they're quite popular within their markets, and also operate in a market that has a high rate of growth, i.e. sales are growing a lot quickly, we call these stars. Products in markets that have high rates of growth, so the market is growing quite quickly, but our product has a low market share, we call these question marks. Now the market is growing quite quickly, so there's potential rewards to be had, but we have a low market share. Our particular product is not that popular. So we call these question marks. We have to make a decision about these. Products that have high market shares in markets that are now quite stable and have therefore low rates of growth, maybe are saturated markets that have already grown, we call these products cash cows. And these, as you expect, these tend to be highly profitable and generating money for us. Products that have a low market share in a market that is not growing very quickly, we call these dogs. So let's go through these in a bit more detail. A star product, these are products in our portfolio that have high market share in a high growth market. So these often will experience rising sales revenue. But we have to be aware market growth might attract new entrants, leading to fierce competition, so perhaps a lot of promotional spend will be required. We might also be investing in expanding capacity to keep up with demand, as this is a high growth market. And so as a business, we would think about building these products. We build up our stars. Question marks, these have low market share, but in a high growth market. So we have a slightly trickier decision here to make. We've got potential for these products, but the future is uncertain. Why do we have a low market share? Why is our particular product not that popular when lots of this type of product are being sold. So we might have to consider a lot of investment, perhaps in promotion or adapting the product to make it more popular, but there will be potentially be a return here if we can move the product from being a question mark to being a star. But if we can't, then it might become a dog. So we need to make a decision here. Should we build this product and try and turn it into a star? Should we just take some money from it and then stop? Or should we just stop with this product now? Should we build? Should we harvest? Should we divest? Okay, the next category of products. If we analyze our product range, we might have some cash cows. And this is really what we want to do. We want to have as many cash cows as possible because these are the most useful. High market share in a low growth market. These tend to be established products at the maturity stage of the product life cycle. Revenue is high as the product is the market leader, and costs are low. We have economies of scale and an established brand. What do we want to do here? We really want to get as maximum amount of money from these products, milk them, and we want to hold as many of them as we can. The idea here was that in terms of the Boston Matrix is we want to try and turn our question marks into stars, and we want to turn our stars into cash cows. But the cash cow of today is the star of yesterday, and the cash cow of tomorrow might be the problem child that we've currently got, or the question mark that we've currently got. Okay, dogs are next. They have a low market share in a low growth market. So revenue is low, unit costs may be high due to low scale of production, and these are likely to generate little profit. So what do we do with these? Try and take some money out of them before getting rid of them, or just get rid of them straight away? Dogs are really the least useful in this situation. The rest of them move around in a nice circle, but if we have a dog product, you know, there's a kind of a not particularly useful product to have in our portfolio. But if it's making us a small product, we might decide just to harvest that profit and not do anything with it. Now, there's a relationship here with the product life cycle. Question marks tend to be those products that maybe are in the development or introduction stage, and we've got to still have some investment here to make them more popular. Stars tend to be linked to the growth stage of the product life cycle because we've got high rates of market growth. Cash cows, where we can see the market growth rate is leveled off, there's not so much growth here, but we've got quite a high market share, so this is generating a lot of money. And so we can try and move these around. We can use the money from the cash cow to fund the development in the question mark, which then hopefully becomes the star, which then becomes the next cash cow, and so on. So we can move products through until eventually they might meet the decline stage, become dogs. But if we can, we might try and generate or use extension strategies to prolong the life cycle of a dog. So in this video, we've looked at what is meant by a product portfolio. We've looked at the Boston Matrix way of analyzing our portfolio of products, the characteristics of stars, question marks, cash cows, and dogs. I should mention here, sometimes question marks are called problem child, a problem child in some business resources. And then lastly, we've assessed the usefulness of the Boston Matrix. So why is the Boston Matrix useful? Well, it helps business to analyze and manage their product portfolio. We can identify suitable strategies for the products based on their position in the matrix. But it only considers really market share when judging how successful a product is. And it only considers market growth when judging how attractive a market is. There might be other factors we would look into, and also only looks at current data, not trends or predictions for the future. So that marks off the assessing the usefulness of the Boston Matrix and brings us to the end of this video. That's it. Thanks for watching.